The U.S. central banking system, the Federal Reserve, or the Fed, is the most powerful economic institution in the United States, and perhaps the world. Its core responsibilities include setting interest rates, managing the money supply, and regulating financial markets. It also acts as a lender of last resort during periods of economic crisis, as demonstrated during the 2008 financial meltdown and the COVID-19 pandemic. Since 2020, the central bank has struggled with how to slow rapid inflation without damaging economic growth. Given the immensity of its powers, the Fed is no stranger to controversy. Some economists have argued that its aggressive policies risk inflation and asset bubbles, while others feel the Fed's support for financial markets favors big business over workers. The central bank is also one of the most politically independent U.S. government bodies, which has long caused tension with lawmakers and presidents. For most of the 19th century, the United States had no central bank to serve as a lender of last resort, leaving the country vulnerable to a series of financial panics and banking runs. In response, Congress passed, and President Woodrow Wilson signed into law, the 1913 Federal Reserve Act, which created a Federal Reserve System of 12 public-private regional banks. The New York Fed, which is responsible for the heart of the nation's financial life, has long been considered first among equals. It runs the Fed's trading desks, helps regulate Wall Street, and oversees the largest pool of assets. The Federal Reserve Districts. Each of the 12 districts has a main bank, the largest of which is the Federal Reserve Bank of New York. Districts are identified by their number and the city where the main bank is located. Today, the Fed is tasked with managing U.S. monetary policy, regulating bank holding companies and other member banks, and monitoring systemic risk in the financial system. The 7-member Board of Governors, the system's seat of power, is based in Washington, D.C., and currently led by Fed Chair Jerome Powell. Each member is appointed by the President to a 14-year term, subject to confirmation by the Senate. The Board of Governors forms part of a larger board, the Federal Open Market Committee, FOMC, which includes 5 of the 12 regional bank presidents on a rotating basis. The FOMC is responsible for setting interest rate targets and managing the money supply. Historically, the Fed has been driven by a dual mandate: first, to maintain stable prices, and second, to achieve full employment. The Fed sets an annual inflation target of 2% in pursuit of price stability, and economists debate the definition of full employment but generally accept it to mean an unemployment rate of around 4 or 5%. In August 2020, the bank announced that it would begin tolerating periods of higher inflation to make up for periods when it is lower, though it has not yet embraced this practice. To fulfill its mandate, the Fed's most important lever is the buying or selling of U.S. Treasury bonds in the open market to influence banking reserves and interest rates. For instance, the Fed's purchase of bonds puts more money into the financial system and thus reduces the cost of borrowing. At the same time, the Fed can also make loans to commercial banks, at an interest rate that it sets, known as the discount rate, to increase the money supply.